The collapse of FTX crypto sent ripples through the entire cryptocurrency industry, leaving billions in limbo. The company was founded by Sam Bankman-Fried and backed by major venture capital firms. Prosecutors say Bankman-Fried used FTX to siphon money from customers and bolster his own hedge fund, Alameda Research. Now he's facing charges that could cost him millions. FTX Token FTT. FTX was one of the world's largest digital currency exchange platforms for buying and selling cryptocurrencies. These platforms have grown in popularity in recent years as people sought to invest in cryptocurrencies without the technical hassle of setting up their own crypto wallet. But the bankruptcy of FTX and its founder Sam Bankman-Fried has left investors in limbo, with the company's assets in escrow and its future uncertain. The FTX token FTT was created to incentivize users to trade on the platform. Those who held FTT could take advantage of lower transaction fees and earn rewards for using the platform. Additionally, FTT holders were able to use their tokens as collateral for futures trading. However, the cryptocurrency market's decline in late 2022 spooked many investors, and as a result, FTX froze withdrawals and new account creation. This move led to a massive sell-off, and the company was forced into bankruptcy in November of that year. FTX's problems have led to regulatory scrutiny from governments around the globe and have hurt investor confidence in other crypto startups. When Changpeng Zhao, CEO of Binance, announced that his company would be offloading hundreds of millions of dollars worth of FTX tokens, it spooked investors and sent the value of the currency plummeting. The withdrawal freeze and bankruptcy proceedings have also hurt investors in the US, who are now facing a tough time getting their money back. Despite the bankruptcy of FTX, its FTT token is still traded on some exchanges. The token is an integral part of the FTX trading platform and offers several benefits to its holders, including free daily ETH and ERC20 withdrawals and higher referral rates. It is also possible to purchase FTT with fiat currency. In the past, FTX was one of the most popular crypto platforms for buying and selling non-fungible tokens, NFTs. The company's popularity declined after its bankruptcy, which is believed to be due to mishandling of customer funds. However, the company did not disclose these issues publicly until the last few months of its existence. It has also been criticized for slow customer support. Unlike other cryptocurrency exchanges, FTX does not offer live chat or phone support, and users must submit a ticket to receive help. FTX Exchange. FTX is a Bahamas-based exchange where customers trade digital currencies for each other and traditional money. It's one of the world's largest exchanges and has spent millions lobbying lawmakers to institute crypto-friendly regulation. But a string of financial troubles and regulatory scrutiny has wiped out billions of dollars in customer assets. Its collapse leaves more than 1 million suppliers, employees and investors without a way to get their money back. The company's demise is rooted in a little-traded digital token called FTT. Like other exchanges, FTX created its own currency to reward early investors and motivate traders to use the platform. But those tens of millions of tokens weren't widely distributed, which is necessary to allow the market to determine its value and price. Instead, they went mostly to FTX and its affiliated companies, including Bankman-Fried's hedge fund, Alameda Research. FTT's ties to FTX also played a critical role in its collapse. The SEC complaint alleges that Bankman-Fried commingled the two entities' funds and granted Alameda Research special treatment on its platform, such as a virtually unlimited line of credit funded by FTX's customers. It also exempted Alameda from key FTX risk mitigation measures, the complaint states. As a result, Alameda took on too much risk and lost big in the downturn that started at the beginning of 2022. When FTX's own assets stalled, the company began borrowing money from its customers to stay afloat. This was a major red flag, and the SEC says that it was the last straw. FTX's collapse may have been prevented had it taken a few basic steps to protect its customers. For example, it could have put in place more sophisticated checks and balances for its users' funds. It also should have established clear lines of communication between its users and the companies they invested in. In addition, it should have gotten better advice from its legal counsel. This would have saved the company a lot of pain, But it's too late for FTX and its hundreds of thousands of users, many of whom are now facing massive losses. FTX trading platform. FTX's wide range of products and easy-to-use desktop and mobile trading apps drew customers from all over the world, including seasoned Wall Street investors. The company also attracted a number of celebrity investors, including Steph Curry and Shaquille O'Neal. In addition to trading fees, FTX earned revenue through NFT marketplace fees, margin borrower interest, and institutional loan service fees. It also earns interchange fees from merchants who accept cryptocurrency payments. But as FTX's meteoric rise went to hell in a handbasket, the company began to face liquidity crises. Its debt was growing as investors demanded redemption of their digital assets. Then the market crashed and the firm collapsed. Its investors lost billions of dollars and billions more are owed to creditors. The collapse of FTX started with the publication of a damning report by CoinDesk, which discovered that Bankman-Fried's other business, Alameda Research, was closely linked to FTX and depended on its native token FTT for the majority of its assets. When this was revealed, it prompted many FTX customers to withdraw their funds. This was followed by an avalanche of investigations and reports from regulators, including the SEC. The SEC alleged that Bankman-Fried hid the extent of his company's ties from investors and that he never oversaw compliance with the law by either overseeing Alameda or appointing an officer to do so. During his time at FTX, Bankman-Fried also used customer funds to cover Alameda's debt and for lavish real estate purchases and political donations. He also allegedly instructed FTX's risk engine to ignore Alameda, creating an unlimited line of credit funded by FTX's customers. Despite the collapse of FTX, many investors remain optimistic about the future of crypto. Some are even planning to move their assets back into the industry despite being left without access to their money. One such investor, Evan Luthra, told CNBC that he plans to invest in more cryptocurrencies, despite the fact that he will probably never get his $2 million back from FTX. "I'm not scared of losing the money," he said. "I'm just sad." Fortunately, the collapse of FTX is unlikely to derail the overall growth of the cryptocurrency industry. FTX Security, Sam Bankman-Fried, whose now bankrupt crypto exchange owed more than 1 million people money, built his FTX empire with slick marketing and high-profile investors. The shaggy 30-year-old who favored board shorts over button-down business suits was even likened to disgraced Wall Street financiers and companies such as Enron and Bernie Madoff. Founded in 2017 by Bankman-Fried and associate Gary Wang, FTX was a platform that let people buy and sell digital currencies. It claimed to be safe and secure, backed by top venture capital firms such as Sequoia Capital and Paradigm Funds. It also sported the seal of the New York Stock Exchange and offered 2FA and password protection for withdrawals. But despite these promises, FTX was anything but safe and secure. Its coffers were filled with customer deposits, money that customers deposited into the exchange to trade cryptocurrencies. But rather than hold those funds on a one-to-one basis, FTX used them as a source of operating capital and as leverage for riskier trades. It was an exchange, a broker, and a bank all in one, says Mazzola. By late 2022, things were starting to go south for FTX and its numerous affiliates. Cryptocurrency trade publication CoinDesk got its hands on a balance sheet for Alameda Research, an investment firm linked to FTX. It revealed that the company was relying heavily on its own native cryptocurrency FTT, which made up the majority of its assets. This was a big red flag that Alameda Research's operations were shaky. Soon rumors of trouble spread and FTT prices plummeted. Traders rushed to withdraw their funds, and the equivalent of a bank run ensued. Then, a flurry of press coverage prompted Changpeng Zhao, the CEO of the massive Binance crypto exchange, to offload his company's shares in FTX, further tanking the value of FTT. The bankruptcy of FTX sent shockwaves throughout the cryptocurrency and DeFi, distributed finance using blockchain industries. It was a reminder that the industry is still nascent and that rogue operators can erode investor confidence. And it was a lesson that crypto investors should take greater care to scrutinize the security measures of exchanges and brokers before depositing their hard-earned coins.